Well, students and viewers of my channel, today I am Dr. Bhaskar Vishwas, Assistant Professor of Commerce of Raja Rammohn Rai Mahavidyalaya, Manakul Hooghly. We'll discuss about the mutual fund, what is mutual fund, advantages of mutual fund, and different types of mutual fund under the subject Indian financial system. Let's start. What is mutual fund? Mutual fund is a trust that pulls together the resources of investors to make a foray into investments in the capital market, thereby making investor to be a part owner of the assets of the mutual fund. The fund is managed by a professional fund manager who invests the money collected from different investors in various stocks, bonds, or other securities according to specific investment objectives as established by the fund. Now let's discuss what are the different advantages of mutual funds. Generally, why an investor will invest his hard-earned money in mutual fund. Consistent return. Due to diversification in investment portfolio, the mutual fund can give steady return over the period. If the total money is invested in one particular stock, then the return will not be steady over the period of time. Encouragement to saving. Investment companies provide higher return than government securities and hence provides an incentive to households to save more and invest through these companies. Mobilization of savings. It has been empirically seen that mutual fund investments are much safer than direct equity investments and they offer a higher return. So, a lot of individuals go for this route of investment. So, mutual fund investment companies have become a new vehicle for mobilization of savings. Investment can channelize to specific sector by the government. Provide liquidity in the market. There are generally larger players which add to the liquidity of the market. They generally purchase in larger quantity and hence can be very useful in providing liquidity when there are large seller in the market. For securities which are very high value, presence of large player is must for their liquidity. Also, liquidity is the means of being able to sell holdings in investment company quickly and at a fair price. Professional money management. Generally, the mutual fund houses employ professionally educated and trained and experienced fund managers to look after their asset under management. Fund managers and analysts save time and effort by researching and analyzing the securities that may be hard to find out about your own. Diversification, a basic investing principles of investing is diversification, which says that you should not put all your eggs in one basket. Investment companies invest in different companies, hence provide benefits to the investor, the benefit of diversification, and now last, the lower transaction cost. Mutual fund trade in many times more shares than does the average investor. As a result, the brokerage are often willing to accept lower transaction fees as necessary cost of doing business with mutual funds. As an individual investor making your own trades, you are unlikely to get as good of a price. Now, let's discuss the different types of mutual funds. According to maturity, there are two funds, open-ended fund and closed-ended fund. Open-ended fund, it is a mutual fund where number of outstanding unit is not fixed. The investor can make entry and exit at any time. If the investor desires to liquidate its investment in mutual fund, the fund itself buy backs the units as is ready to sell new shares. And close-ended. It is a mutual fund where the number of outstanding units is fixed and scheme has a limited life at the end of which the corpus is liquidated. Now, the classification of mutual fund according to the investment objectives. Growth oriented schemes. Generally, these funds offer growth potentials in the market, high source of income by way of dividend, and rapid capital appreciation, both from holding good quality scripts. These funds primarily concentrate on the low risk and high yielding spectrum of equity scripts of the corporate sector. Next one is income oriented schemes. These funds offer fixed income to the investors. Main securities in which investments are made by the fund are fixed income yielding securities. And next one is hybrid scheme. Hybrid scheme is the mixture of equity scheme and balance scheme, where an investor can get the growth as well as protection. The growth is getting from the equity scheme or equity investments, and the protection is getting from the investment in fixed income securities like bond, government securities, etc. High growth schemes. This fund invests in high risk and high return volatile securities and induce the investors with high degree of capital appreciation. Capital protection oriented. It is a scheme which protects the capital invested in the mutual fund through suitable orientation of its portfolio structure. Tax saving scheme. Tax saving schemes the schemes offer tax rebates to the investor under tax laws as prescribed from time to time. Under 80C of the Income Tax Act 1961, we can get deduction up to rupees 1,50,000 if we invest in tax saving schemes. Special schemes. This category includes index schemes that attempt to replicate The performance of particular index such as the BSE or Sensex or NSE 50 or Nifty 50 or industry specific schemes or sectoral scheme. Real estate fund. These are close-ended funds which invest predominantly in real estates and properties. Offshore funds. Such funds generally invest the money into the foreign companies with RBI or Reserve Bank permission. Leverage funds. Such funds increase the size and the value of portfolio and other benefits to members from out of the excess of gains over cost of borrowed funds. Hedge funds. They employ their funds for speculative trading, that is, for buying shares whose prices are likely to rise and for selling shares whose prices are likely to dip. Fund of funds. They invest only in units of other mutual funds. Such funds do not operate at present in India. New Direction Fund. They invest in companies engaged in scientific and technological research such as birth control, anti-pollution, etc. Exchange Traded Fund or ETF. It is a hybrid between mutual fund and a stock. Like a stock, it can be traded on the stock exchange, and like a mutual fund, it behaves like a diversified portfolio. Money market mutual fund. These funds invest in short-term debt securities in the money market like certificate of deposit, commercial papers, and government treasury bills, etc. It gets a higher yield on such short-term investment than individual investor. Infrastructure fund, they invest primarily in debt securities or securitized debt investment of infrastructure companies. Last one is sectoral funds. This fund invest their collected funds into the particular sector or share of particular sector such as banking sector, technological sector, etc.